Hello everyone. Today our group will be presenting Sistich Berhad. Hi, my name is Yusmarina binti Basri. My number matrix BB25110053. Today I want to present background and nature Sistich Berhad. Sistich Berhad is a technology company listed on the SE market of Bursa, Malaysia. Initially, the company focused on a business solution and cybersecurity service, providing digital solutions to corporate clients. Over time, Sistich Berhad expanded its business scope in line with technological advancement and market demand. Currently, the company operates as an integrated digital solution provider, offering services in cybersecurity, digital transformation, artificial intelligence (AI) automation, and human capital management (HCM). Its cybersecurity service set mainly to corporate organizations and financial institutions, while its AI and HCM solutions support business in digitalizing internal operations. In addition, Sistich Berhad is involved in technology infrastructure solutions, including data center infrastructure and high-performance computing (GPU as a service), which support AI computing needs in local and regional markets. Overall, the company's operation reflect a strong focus on innovation, technology-driven service, and enterprise digital. Okay, next is key financial ratio across 5 years. The first one is profitability, the second asset efficiency, the third is liquidity, and the last leverage.
Hi guys, my name is Nurfatia Sofia binti Tumiran. My number matric is BB25110380. So I will present my part, which is profitability and asset. The first one is gross profit margin. Gross profit margin measures the percentage of revenue remaining after deduction the cost of goods sold. The margin declined steadily from 53.63% in 2020 to its lowest point of 38.29% in 2023, mainly due to rising cost of sale. The decrease indicates that production or service costs increased faster than revenue during this period. In 2024, the margin improved to 42.29%, reflecting better cost management and pricing strategies. Overall, the trend shows a gradual recovery in the company's ability to generate gross profit. Next, operating profit margin. Operating profit margin measures the company's profitability from its core business operation. The margin declined from 3.20% in 2020 to negative 26.58% in 2022 due to high operation expenses exceeding gross profit. A recovery was observed in 2023, with the margin improving to 4.20%, indicating better operational efficiency. However, the margin turned negative again in 2024 at negative 17.23% despite higher revenue. This suggests that operating costs remain high and continue to pressure operating profitability. Net profit margin shows an actual profit earned after deduction of expenses, including interest and taxes. The margin declined from 0.68% in 2020 to negative 26.47% in 2022, mainly due to substantial net losses. The company recorded recovery in 2023, achieving a positive margin in 1.68%. In 2024, the margin dropped again to negative 21.93% despite an increase in sales revenue. This indicates that rising costs and expenses continue to erode the company's overall profitability. Next, I will present about asset efficiency ratio. Total asset turnover ratio. The total asset turnover ratio measures how efficiently the company utilizes its total asset to generate sales revenue. The ratio declined from 0.46 times in 2020 to 0.38 times in 2021, mainly due to a significant decrease in sales during the pandemic period. From 2021 onward, the ratio showed a consistent improvement, reaching its highest level of 0.62 times in 2024. This improvement was driven by an increase in sales growth as at a faster rate compared to total asset growth. Overall, the trend indicates that the company become more efficient in managing and utilizing its assets to support business operations. The fixed asset turnover ratio evaluates how effectively the company uses its net fixed asset to generate sales. The ratio declined from 0.56 times in 2020 to 0.48 times in 2021, reflecting weaker sales performance and underutilization of fixed assets. A sharp increase was recorded in 2023 at 1.95 times, mainly due to a significant reduction in net fixed assets, possibly from asset disposal or through depreciation. In 2024, the ratio decreased to 0.94 times as the company reinvested in fixed assets to support future expansion. This indicates that while asset utilization improved, new investment temporarily moderate the efficiency ratio.
Hello, my name is Shazri Hezbinazal, and I will now be talking about the liquidity and the leverage part of the presentation. Firstly, for the current ratio, in 2020, Sistek Berhad recorded a strong current ratio of 4.62 times, indicating a high ability to meet short-term obligations. The ratio gradually declined to 3.98 times in 2021 and 3.65 times in 2022, reflecting faster growth in current liabilities compared to current assets. Although liquidity remained at a safe level, in 2023, the current ratio further decreased to 3 times, suggesting that liquidity was approaching the minimum stable threshold, possibly due to increased trade payables and short-term commitments from the business expansions. A significant deterioration occurred in 2024 when the ratio fell sharply 0.8 times, indicating insufficient current assets to cover all current liabilities and higher short-term liability risk. Overall, the declining risk highlights a weakening liquidity position, emphasizing the need for improved cash flow and management and tighter control over short-term liabilities to maintain financial stability. As for acid test ratio, in 2022, Sistek Berhad recorded an acid test ratio of 3.61, indicating a strong ability to meet short-term liabilities using highly liquid assets without relying on inventory. The ratio increased slightly to 3.96 times in 2021 before declining to 3.65 in 2022, showing that liquid assets and current liabilities are moved at relatively balanced rates while liquidity remain well controlled. A significant improvement was observed in 2023 when the asset test ratio rose sharply to 6.62 times, reflecting a very short and strong liquidity term position, likely due to higher liquid assets or lower current liabilities. However, in 2024, the ratio declined sharply to 0.8 times, indicating that liquid assets were insufficient to cover current liabilities and signaling increased short-term liquidity risk. Overall, while Sistek Berhad maintained a strong liquidity from 2020 to 2023, the sharp decline in 2024 highlights rising liquidity pressure and underscores the need for improved cash management and tighter control. over short-term liabilities to ensure future financial stability. Next, I will be talking about the leverage part of the presentation. For the first part of leverage is debt ratio. The debt ratio measures the proportion of a company's assets that are financed through debt. In 2020 and 2021, Sistek Berhad recorded low debt ratios of 0.15 and 0.16, indicating that most assets were financed through equity and that financial risk remained low. The ratio increased to 0.24 in 2020 and 0.30 in 2023, reflecting a gradual rise in the use of debt financing, and a significant change occurred in 2024 when the debt ratio rose sharply to 0.54, indicating that more than half of the company's assets were financed by debt and signaling a substantial increase in financial risk. Overall, the upward trend highlights increasing reliance on debt, emphasizing the need for careful debt management to maintain a financial stability. Next is debt to equity ratio. The debt to equity ratio measures the extent to which a company relies on debt or refinancing relative to their shareholder funds. From 2020 to 2023, Sistek Berhad maintained a low debt to equity ratio within the range of 0.21 to 0.23 times, indicating a stable company structure and low dependence on debt. In 2024, the ratio increased significantly to 0.5 times, reflecting a notable rise in debt financing. Although the ratio may remain below the 1.0 times benchmark, the sharp rise signals that Sistek Berhad has begun to increase its financial leverage. Overall, this trend suggests a shift towards greater reliance on debt, highlighting the importance of monitoring leverage levels to maintain a financial stability. Next and final part for the leverage is equity ratio. The equity ratio measures the extent to which a company's assets are financed by shareholder funds. In 2020 and 2021, Sistek Berhad maintained a strong equity ratio of approximately 0.72 to 0.73, indicating a stable financial position and low reliance on debt. The ratio increased significantly in 2022 and 2023 to 1.616 and 1.32, reflecting the dominance of equity financing over debt during this period. In 2024, the equity ratio declined slightly to 1.09, in line with the increased debt refinancing. Despite this decline, the equity ratio remained at a relatively high level, indicating that equity continued to play a major role in financing the company's assets and supporting overall financial stability.
Financial strengths and weaknesses. First, in terms of liquidity, from 2020 to 2023, the company showed very strong liquidity. This indicates that the company had more than sufficient short-term assets to meet its current obligations and was financially stable in the short term during this period. However, in 2024, both liquidity ratios collapsed sharply to 0.80 times, indicating that current liabilities exceeded current assets, which placed the company in a risky short-term financial position. Next, regarding leverage and solvency, the company experienced a low debt risk from 2020 to 2023, reflecting a low reliance on debt financing. In contrast, a high debt risk emerged in 2024, as over half of the company's assets are now financed by debt, significantly increasing financial risk and weakening long-term solvency. Moving on to asset efficiency, the company showed a strong improvement in fixed asset turnover from 2020 to 2023, which indicates excellent utilization of fixed assets during this period. However, efficiency weakened slightly in 2024, suggesting that new asset investments are not yet generating sales in proportion to their value. Finally, in terms of profitability, the company experienced a continuous decline in gross profit margin. which indicates rising costs or pricing pressure. In addition, the operating profit margin was highly volatile and frequently negative, suggesting poor cost control and operational inefficiencies. As a result, the company is not consistently profitable, which raises concern about its ability to sustain operations in the long term. Areas for improvement and red flags. One key red flag is the surge in current liabilities in 2024. The company experienced a sudden increase in current liabilities without a matching increase in current assets. This indicates potential cash flow stress, increased short-term borrowing pressure, or ineffective working capital management. As a result, the company may struggle to meet its short-term obligations without relying on refinancing or asset liquidation. Another major concern is the sudden accumulation of debt in 2024, with the total debt more than doubled. The higher level of leverage, when combined with poor profitability, significantly increases the company's default risk. This situation may also lead to higher interest burdens and reduced financial flexibility, limiting the company's ability to respond to future financial challenges. In addition, there is evidence of possible overinvestment or underutilization of fixed assets in 2024. Sales growth did not keep pace with the expansion of the asset base, suggesting the newly acquired assets are not yet generating sufficient revenue. Management should therefore ensure the future investments contribute more effectively to revenue growth. Finally, the company faces major profitability concerns. Operating expenses remain high relative to sales, and the company has been unable to consistently convert gross profit into operating and net profit. Persistent losses combined with rising debt levels significantly increase the company's overall financial risks.
Good evening, this is Lam Yifeng, and now I will continue with conclusion and recommendations part. In conclusion, based on the analysis, we have concluded 4 parts, which the first is liquidity crisis. Both the current and asset test ratio have dropped below 1.0 benchmark in 2024, meaning the company cannot meet short-term obligations easily. Second, leverage concerns. There has been a sharp rise in the debt and debt-to-equity ratio. This shows a heavy dependency on debt financing, which exposes the firm to significantly higher financial risk. Third is profitability gap. Despite earlier strengths, the company has transitioned from strong profit to operating and net losses due to poor cost control, and lastly is efficiency limitations. While asset efficiency ratios show slight improvement, it was insufficient to stabilize the overall declining financial condition. Next is recommendation. To improve company's performance, we suggest 4 ways. First is stabilizing cash flow. By moving away from traditional models toward subscription-based services, Systech aims to ensure constant cash inflows. This strategy is intended to provide a necessary working capital to meet high operational costs and short-term obligations. Second, infrastructures and expansion. Utilizing debt and equity to fund high-growth strategies, specifically regional expansions into neighboring countries. Third, GPU as a service. This shift to an enterprise-scale GPU as a service platform is intended to replace one-off sales with a steady stream of revenue. This model is designed to facilitate margin expansion and return the company to sustainable net profitability over time. Lastly, maximizing assets efficiency. The development of integrated digital ecosystem, which combining AI, PropTech, and e-invoicing to focus on maximizing output. By leveraging its 51% stake in ProPapa, the company seeks to generate the highest possible sales volume from its assets infrastructure.